It seems those strong gains we've seen since the beginning of December really seem to be tapering off as we head further into the month. Commodity prices under pressure, and that's putting some pressure on the South African market.
I think it's quite typical for this time of year where you find before people go on the annual break that they do just want to take some money off the table, maybe lock in some of the gains that they've been able to achieve over the last quarter or even the year, and really just to reduce the outstanding positions before they go on holiday. So I don't think it's anything to be too concerned about. It's fairly typical for this time of year.
Well, perhaps just looking at some news coming out of the JSE this morning. Of course, we had the quarterly review, the JSE FTSE Africa Index Series. What did you pull out of that quarterly review?
Well, it's not only just the quarterly review that was done yesterday, it's also the annual review. And the reason why that is important is that the liquidity of all stocks are measured once a year to determine if they are liquid enough to be included in all the indices. So this is quite an important event because it often results in some fairly drastic changes to the overall all-share index, not to be confused with the top 40 index or some of the more well-known derivative-based indices. But within the all-share index, what we see is that JSE, the mining company, who for many years were not liquid enough due to its restricted free float, for the first time ever yesterday passed the liquidity screen and will now be included in all the indices. It comes in at the mid-cap level, but very close to the top 40 mark. So depending on share price performance, maybe over the next couple of quarters, we could find that coming into the top 40 index. So JSE, a new constituent into the indices, but we also see quite a number of some of our other well-known stocks who did not make the liquidity screen. Probably the most prominent of those would be Caxton falling out of the indices, and then we get to the financial shares, most specifically Capitec Bank and PSG Group, who both have been liquid enough over the last year to be included in the indices now, and they both are included at the mid-cap level. So those changes will all take effect after the close of business next Friday, the 17th of December, and they would be effective then on the 20th of December. But no changes to the top 40 index, the major index. The only one of the derivative indices that have any changes is the RESI 20, and that is because of JSE that comes into that index and replaces Metrex.
Well, of course, we're going to have a new constituent on the JSE as well from tomorrow. Clover listing, I think, next Tuesday. They finished that book build. That's completed. R10.50 a share, so right in the middle of the range that was outlined for Clover. So it may not make it into the top 40, but certainly an interesting stock to look at on the JSE.
Yes, it certainly won't make it into the top 40, but a very interesting share. And I think the fact that it was so significantly oversubscribed clearly shows that this is the type of stock that the market is very keen on getting its hands on. In terms of where the valuation puts it, probably around about 1.6 billion full market cap. So in terms of full market cap, probably somewhere between Avgri and Country Bird within the food producers section, on a free float basis, around about the size of an Oceania. I think what I'm trying to say with that is the advantage or the attraction for us of Clover is the fact that we are now presented with a very different alternative within the food producer section. And I think it is exactly that attracts fund managers to the stock. So certainly a welcome listing for us on the market next week.
Taking a look at some other news coming out. So we had Capital Shopping Centres falling quite sharply yesterday. It was down 3.5% in South Africa. I think it was down even more on the London markets. That share under pressure again today. And it looks like there is a bit of a dispute going on between Capital Shopping Centres and one of its big shareholders.
Yes, it's a bit of a public spat at the moment. Simon Property Group of the US recently announced that they have acquired 5% of Capital Shop's outstanding share capital. And there was rumours that maybe they would be making a takeover bid for Capital Shops. But then enter the rights issue, the recent rights issue that we had, which was done for the benefit of acquiring the Old Trafford shopping centre to the tune of around £1.6 billion. And the interesting situation that we find here is that the Simon Property Group is very vocal about its opposition to that, going so far as to say that it will be severely value destructive for shareholders. And on the other hand, we have the Australian group that is up until now being seen as a partner for Simon Group in that, but they participated in this rights issue and therefore took up their rights within this, which clearly indicates that they are in support of this. So I think because this indicated that it's very unlikely that there will be a deal on the cards in terms of Simon Property Group bidding to take over CSO, we've seen the weakness in the share price. Because Simon Property Group apparently, or not apparently, they did ask for additional information from CSO, from Capital Shops, so that they could do a proper due diligence. Capital Shops refused. They said that they would not do this unless there is at least an indicative offer on the table. And as a result, people now believe that there might be a share overhang should Simon Property Group decide to sell its 5% shares that it owns in the company.
Nerina, Steinhoff International may pay about 1.6 billion euros for Conforama, which is a French furniture retailer. Of course, we had some numbers out of Steinhoff earlier this week that showed this European furniture business is doing pretty good.
Yes, I think this is another very proudly South African success story in Steinhoff. They've certainly been able to diversify their underlying operations and their offerings way away from South Africa and now even from emerging markets. I think for us, some of the important aspects of this deal is that Steinhoff will no longer be an emerging market player. It definitely will not be a South African player any longer, with less than 15% coming from South Africa. If you look at the comparison of Conforama to POCO, the Polish and Eastern European operations of Steinhoff that it currently holds, Conforama, the addition of Conforama to the Steinhoff stable will make it the second largest furniture retailer in the world after IKEA of Sweden. It's still second by a long margin, but it will be the second largest. I think for us this is really going to be about what is your view on the euro in particular, because really this will be an investment into the European region and into the euro as a currency, and also sort of your time frame as an investor. There will be great synergies to be achieved from a deal such as this, especially within procurement, marketing and sales, distribution and so forth. But these sort of synergies don't happen overnight, and you know, we're probably looking at 2 to 5 years before the full benefit of those synergies will be realized. So for the longer term investor, I think with patience this could really be great. The advantage that we saw today was that the acquisition at the levels that it's currently pitched would not be earnings, it would be earnings enhancing in the first year already, and I think the market was quite pleased by that. So certainly a very good story. Maybe just one slight word of caution or something just to be aware of. This deal will take Steinhoff's debt to equity ratio to around about 80%. So it certainly will mean that they would have to protect their cash flows in coming years, and might have to maybe just exercise some restraint regarding their dividend payments.